To Foliko Live. We are very excited to be with you here today. It is very appropriate that we are coming in today on the 13th of October, the worst luck day of the year. And Tyler, I want to zoom in on your title. What is going on there?
Yeah. So not so much on this inflation report this morning. Bonds getting pummeled again. Equities QQQ down about 2% here. This means no relent from the Fed. I believe the terminal rate where they are expected to stop is currently priced somewhere around like 480. So that means we think they're getting all the way up to 5. And the world in which the policy rate is 5 is very interesting. I mean, especially because if you consider the cross market, cross currency ramifications right now, I mean, the US is bankrupting the UK pretty much, just driving their rates to the moon. Pension crisis, very interesting. I mean, stuff is finally breaking. You're breaking the UK. I haven't done the cross currency adjustment, but just on a nominal yield basis, UK bonds are now yield higher than Greek bonds. So, I mean, there is some euro sterling adjustment that needs to be made there. But I mean, that's pretty remarkable by itself. So we're really seeing some pretty historic stuff. If you're trading this market, if somebody tells you, oh, but 08, I mean, this is we're starting to get shades of 08. Yes, the banking sector hasn't failed, so 08 still wins, for lack of a better term. But this really is some stuff
Credit
here.
Suisse. I mean, could the Credit Suisse effect propagate out?
Well, that's the question, and the problem is those Swiss banks. Let's be real. They had a very specific purpose. Their ability to execute that purpose was removed. So what are they really worth? So that's the question: is this more of a banking crisis, or is this a banking business that was run on something that just isn't prevalent anymore? So that's really the question, and how much systematic risk CS is holding, kind of shoulder shrug. So that's I would say there's a chance that equity goes to zero, gets bought out in bank, kind of weird stuff like that, without really hitting the doomsday button. Like, that wouldn't be it, in my opinion. It would be something else. This would just be a minor nuisance.
The Credit Suisse is specific to them. It doesn't mean that there's something more endemic happening in the market.
Specifically, yeah, I think what's going on with them is a a multitude of factors that are all their specific problem.
So the UK I want to talk about, because the line usually goes, the US sneezes and Europe catches a cold. This time the US sneezed and Britain caught COVID, right?
Best case.
But I mean, what's interesting to me is the market is reacting positively to them doing nothing, right? So the more inaction they have, the better their market does. Every time the government comes in with some kind of action, boom, they're just decimated. So if they can't do any actions, what do they really have in their tool chest? And if that's the case, then what does that say for the world economy?
Well, that's the problem. Is the UK is their policy is more like it's like those old slapstick black and white movies, as opposed to actually attempts at
what to make of that.
at getting anything done. Like the Three Stooges or something. Like, it's just like pratfalls and they're slapping each other across the face. Did you see there was a clip of I guess King Charles had an audience with the Prime Minister of the UK, and she walks in and he goes, "You're back," and he turns around and goes, "Oh dear, oh dear." Like, go look this up. Like, this is a 12-ring circus. So that's really the problem. Is usually what they're doing works, but the spot was completely botched. They tried to do QE to provide the pensions with more time to do what they needed to do, and then 3 days before they were going to close the door, they announced they were going to close the door, effectively closing the door. So, like, this is shameful policymaking more than some of the other things that might be going on. I mean, this is laughable, really.
All right. So Last time we were with you, actually, I think it's 2 times ago, we introduced a new view that uses our data. It makes predictions about the future of the S&P 500, and then it benchmarks that with the current state of the S&P 500. So we're going to do a little bit of review, but I want to show you where it's at today and what that means for the future of the market in our view. Now, we are not financial advisors. This is not financial advice. We just look at interesting data sets and we make interesting predictions. And actually, on that front, I have a few exciting announcements to make for you today. Thank you, Tyler, for flashing up the scroll wheel. All right. So I'm going to share my screen. I don't have 2 screens today, so you're going to get a weird hallway effect. Bear with me for 1 second. There it is. Eternity. All right. So here is our predictions. Now, if you recall, I'm going to do a quick review here. What we have here is a purple line. That is our 5-day out prediction, 1 week, 1 market week, because there's no weekends. That means a week prior to this date, which you see on the screen, would be April 15th, 2019. We made the prediction that the S&P 500 would be at 290. In reality, ended up being at 281. Now, the interesting thing about this is that it is better to trade on the difference between the prediction and the outcome than it is to trade on the actual prediction itself. Because take a look at what happens once you start looking at the world that way. Once we come in and zoom in a little bit so you can see it clearer, look at the end of 2021 out into 2022. When the purple line is above the light blue line, that means you're out, right? That means it's bad conditions for investment. And if you'd have stuck to that investment principle, you would have avoided all of that downside right there. But when the light blue line goes above that purple line, all of a sudden, get back in. It's a better environment. And so you can see that would have led to actually significant positive gains in the market so far this year, even though it's one of the most challenging market environments since 08, possibly even longer. We'll see how this all shakes out. So the long and short of it is we just updated the data, and I want to show you where we're at. We've been risk off, in other words, out of equities in the S&P 500 since August 29th. August 29th was the last time that this purple line went above the blue line. Now, we're nowhere near coming out of that risk-off environment. There was a nice little upturn in the S&P 500 in the beginning of October. Our model said steer clear, even though it was a really tempting environment to say, I want to get part of that upside. We stayed out. And what we're seeing here is a continued downside in the S&P 500. So our models right now, not seeing great things for equities. We're staying heavily biased towards T-bills. Myself, Tyler, we can talk about bonds. Now, one exciting thing is we've been out for a little bit. We've been working on some really exciting stuff. So there's going to be some new data coming out for you here soon. Really interesting view on the market. I can give you a little bit of a preview for what that looks like. Here's some of our variable importance factors. Our systemic variables, which we've been talking about for a few months now, are very important for understanding just the market all up. There's some really exciting stuff going on in this model. It's complex, but it is showing to have quite a lot of weight and value to it. So that's where we're at in the market. Tyler, thoughts on the current state and what's coming out of the data?
Yeah, so that was interesting. Like we discussed, this model has been pretty outstanding, except for the one thing that we discussed, which was how do we navigate these short squeezes? Because you want to maintain your short. You don't want to get squeezed out of your short. So on days where you have a 7% move in 3 days, you can't hold a short for 7%. We know that. You'd get stopped out. That's a VAR and risk and compliance nightmare. But what we do very much see here is we are right on the trend. I mean, this is what this means. This means stay short, use green days to sell. And honestly, we will continue to work on ways of making sure that we don't get squeezed out, or we're able to exit shorts and re-enter. Because that's very important. Position management, size management, especially on the short side, where your targets have to be a bit more specific and you have to be a bit more precise than on the long side, which is a long carry trade, and you can just kind of close your eyes and hold for a while without it getting too ugly. So we like to see this from a are we right standpoint. From a market standpoint, though, this is not this is not what we were looking for. I mean, our initial analysis had said that a bottom is near, but I mean, if our data is accelerating downwards, I'm not really sure how that that comes to pass, really.
Well, and that initial analysis was back in the May timeframe, and it absolutely could have bottomed by then, but the conditions, I mean, really, we're feeling the pain that the Fed has self-induced, right? And this inflation is just, it's not looking like it is going to be given up anytime soon. Core inflation up more than any other time in 40 years. I think that's pretty concerning. And so, you were saying before the show, you don't see the Fed taking their foot off the brake yet.
No, like I said, the terminal rate creeping up to 5%. That's kind of the problem, though, is I don't think this usually, as usual, this doesn't work the way they think it works. So at some point, given this large move higher in rates, inflation will come down. Inflation will come down mathematically because of what's happened to the dollar. Inflation will come down because of the large move in policy that brought us down, or that will be deflationary. It's just a matter of when and how long. And the concerning thing is, if it takes a while longer into 2023 to get any meaningful progress, I don't know what happens. I don't know if the Fed thinks they can get to 6, if they can, I don't understand. I don't know how far they're going to push this, especially because they're still going to push it 75 basis points at a pop. So we could get to some pretty obscene levels pretty quickly, honestly, because they're going so quickly. So we'll ultimately see if there's a pain point for them. They're making it very, very clear that pain point is not here, is not yet. But we'll have to see how this plays out.
Let me ask you about the interplay between China and the US. So the US struggling with inflation right now, China very much not, but struggling with a whole bunch of other economic problems, which looks like the big policy choice that they have is to stimulate, right? So at the same time that the US is trying to cut back on its cash supply, China is doing the exact opposite. My question to you is, who's lagging whom?
In terms of overall contribution to market performance?
Well, issues like inflation tend to spread, right?
Right.
Why
Okay,
has
so
it spread to China? So these are two historically, not historically, but over the past 10 years have been quite interlinked. It may speak to the fact that China and the US are less linked than ever before. But the question is China going to be following the US into inflation, or is the US going to be following China into stimulus?
Well, just kind of given the backdrop of the not PBOC, the party in charge in China, their meeting is now largely behind us. So we assume that China will start to open up some, which should be inflationary. So that's going to be interesting, is that Chinese reopening probably net pushes global inflation higher, not lower. So that'll be a very interesting, energy demand higher, things like that, all higher, consumption higher, right? So the most people in the world. So that will be very interesting, because that will be another inflationary pressure that the Fed will have to deal with. And I mean, especially if you look at, sorry to cut you off,
That's all good.
Just kind of occurring to me. If you look at dollar China, the cross, that's getting to some pretty scary levels in terms of.
Can you pull that up so our viewers can see it? Because I think that might be interesting. I think that this is something that matters in the future. And especially as these two economies that have been entangled, disentangling, it's not going to be an easy process. There was a lot of economic good coming out of that relationship, and the more it starts to split apart, the more pain we're going to feel in real terms.
So let's check this out. I got this weird line going on, which is kind of annoying. Instead of my usual, but look at that. Let's take it back to.
You want me to start sharing your screen?
Oh, that would be good.
Cool.
So this is what dollar China looks like. I apologize for this ridiculous line. I don't know why it's not in bars like it usually is.
Is it style line at the top?
Yeah. All right, bingo. God, sorry guys, this is kind of a disaster. Oh, we got some kind of wrong axis deal going on, because this looks like something else. Yeah, because it's down here. Okay. All right. Weird. All right. Anyhow.
So what are we looking at here?
This is the currency cross, dollar versus Chinese yuan. And what I would like to do is, we're just not really. So this is important. In 2016, there was a pretty large volatility event caused by China started kind of moving the peg. There was a short-term spurt of volatility, not moving the peg. They started moving higher against the peg. And we had a pretty big vol event. If I remember correctly, the Fed moved their lift off from their hiking cycle from September to December. So that level was kind of 7, and we're through that level. So that's another thing that I think there's so many bad things going on that other bad things that I think are potentially worse are going by the wayside. Like if you ask me what I'm more concerned about, the housing market or that, I'd say that.
Really?
That has large ramifications. That if that runs away.
Well, actually, and I apologize for this, but I want to back up and make sure our viewers know what it is we're looking at. So the higher that line goes, the more valuable the US dollar is compared to the yuan. Is that right?
Yes.
Which means that it's cheaper for us to buy Chinese goods, and they get less money from us whenever they sell anything. So talk to us about the ramifications. Why is that more concerning than the housing market?
I mean, it's kind of twofold. One, the cheaper China gets in the competition between the US and China, that's net, you would think a bad thing as they will receive more demand, right, at a better price. That would just be the first kind of guess. The second thing is for the more macro thing is, I mean, this is probably like the best way to look at like pure inflation or pure deflation. Because eventually this is where inflation will turn into deflation. The dollar will and has strengthened so much that it will weigh on our inflation and become deflationary. So that if that runs away, that's how we get from inflationary bust to deflationary bust pretty quickly, I think. Not something
Which sounds good to people on the outset. You're like, oh, inflation's a problem. The opposite must be a solution, right? But that's not the case, because then we whipsaw. Then we go from businesses being able to charge more and more to all of a sudden the demand falls out from under them because there's cheap competition coming from abroad, which kills our employment. Unemployment just skyrockets at that point.
Right. It's about as bad as it could possibly be.
If everyone recalls, this was one of the big things that caused unemployment to be considered a new higher steady state at the end of the 08 crisis. We had deflationary problems, and this caused a higher steady state unemployment rate in the US. And that's why we had such a long period of recovery coming out after 08, which could be a double hit to us. It means that we've got this really sharp downturn coming here this year, but could elongate the recovery that we would see coming out of it. Is that kind of the picture you're painting for us here, Tyler?
Yeah, it would just be like pulling the rubber band all the way up and then, it flying down. So now you're stuck with all this inventory that just completely changed price. Yeah, that's probably, one of the worst possible outcomes. That's just the dollar doom spiral. We end up with all sorts of knock-on currency issues across probably APAC. So that's not something I'm calling for. The PBOC is pretty excellent at managing that level. So,
they are when they're focused on that.
Right.
When their focus is on economy instead of control. But the focus is not on the economy right now. It's completely uncontrolled. They are navigating an enormous amount of issues to just keep the economy stable. And so their focus might not be trying to curb that particular problem.
Yes, and that's the other problem is most governments now are fighting multi-front, if not actual wars, political wars, right? Like where this is getting very multipolar. It's getting very multi-factor very quickly. So yes, the currency is something that could potentially fall by the wayside, especially given all the gestures wildly, all these other things going on.
Well, all right. So I want to talk about that for a few minutes, unless you have any last thoughts on the view here.
No, just keep that on your watch list. Make sure you're aware of what's going on there.
So this show is apolitical, right? We're not going to take a side on any political issues except for when it comes in and actually starts affecting markets. And I think that we're entering political environments here that are going to affect markets. We've got a midterm session right here, which typically the market tends to go up after midterm because there's this uncertainty period. But what I find is interesting is how little the news cycle the midterms are soaking up these days. Yeah, you can't watch a YouTube video in Virginia without hearing about Abigail Spanberger and whoever she's running against. But oh my goodness, I hate that. But at the same time, the news cycle is what? Russia, Ukraine, China's housing crisis. There's enormous things, whether or not Joe Biden thinks a certain person is alive today or not. These are not exactly like politics is not really in the forefront. So that uncertainty doesn't seem like it's going to be coming back and helping the economy after the midterms. So at what point does politics really start playing a bigger role in where markets are going? It almost seems a little bit muted as compared to the typical midterm cycle.
Yeah, and to add to that point, I can't believe that the Democrats aren't louder about the fact that the Fed is negatively impacting the economy in terms of job, like outright. They are specifically saying we want lower growth, we want more unemployment. A month before, it's shocking that I think Elizabeth Warren's the only one who spoke up. There's no, hey guys, this is really bad for us politically because it looks like, this additionally is our fault, right? Which it may or may not be, but for this degree of tightening, traditionally, I believe the Fed has been kind of less heavy-handed, but I think they used to pretend to be apolitical. They don't even pretend anymore. So that's kind of why I'm so surprised is that this is so negative and nobody's really saying, hey guys, you should probably, do less of that for a little while or something. So that's very interesting and something I'm watching. But yeah, to your point, we're what, under a month away, and yeah, it's not on the forefront of everybody's mind.
I knocked Joe Biden a little bit because he doesn't know who's alive and who's dead. When you're that close to the end, you start not being able to tell the difference too much.
Yeah.
But I will say, doesn't that give a little bit of credit to the Democratic Party that they haven't? That it seems to me, and I'll give credit where I see it's due. It seems to me that they're recognizing that what the Fed is doing is overall, in their view, a positive thing for our country, and they're not trying to stop it, even though it's politically horrible for them.
That would be the best interpretation of that. Yes. So let's just hope it's that.
Okay, nothing to do with incompetence at all.
No, but that would be a nice interpretation. That would be a nice thing that would be happening. Do I think that's happening? Absolutely not. But it would be nice.
Well, I'm going to say it that way because I gave Joe Biden a little bit of shade, so we're going to do it. The next thing I want to talk about is state by state. California is coming out with a stimulus for people in the midst of this huge inflation. They're giving people inflation stimulus, which to me sounds like it's a page out of Erdogan's book in Turkey, where he says everyone's wrong about inflation. What you really need is more cash, right? So California versus Texas and Florida, there's obviously a Republican versus Democrat viewpoint there. They're going in opposite directions. Texas and Florida seem to be emphasizing more on the austerity. California is more on the let's give cash to people who need it, while cash is worth less and less. Who's going to win out?
I mean, people are voting with their feet, right? If you look at where people are moving, they don't want they're literally fighting fire with more gasoline. So that's been, I forget. I saw some article again, just reaffirming basically how many people have left California and gone other places because of the, the financial burden of living there, especially as things become more decentralized. I think it's pretty much as simple as that. It's literally hey, if you stay here in this complete disaster, we'll pay you a little extra money, and that's just not worth it for people who, are getting taxed, certain amounts. It's a significant savings to go elsewhere, and if you can, you do.
But Gavin Newsom is really handsome, Tyler, and I think that's the point here. All right, so which is all the news can ever talk about, but he sure is handsome.
Really likes eating at French Laundry too.
Just make sure the wait staff has a mask. That's the important thing. All right. COVID ending. We all thought we would be in a better economic environment. Everything seems to be hurting except for one area. And I think that this is something for us to actually take a moment and be proud about, Tyler, because I think that we've been calling this area out since the early summer. So where are stocks really doing well? We've seen an enormous surge in the benefit of biotech.
Yeah.
Look at Moderna and their new cancer vaccine that they announced today. And they were up 10% last time I checked. And then there was the Alzheimer's announcement earlier. Again, we mentioned this earlier. Where's the innovation coming from, and where is that going to start building pockets of value in the economy that are yet to be realized? And I think that the 2010s were the era of big data, being able to put that in the cloud, store and analyze it effectively and efficiently. And that takes the form of streaming video. Really, that's just storing data and delivering it efficiently. That's all video streaming is. Next, you have social media. Again, that's storing a lot of people's data and photos and cat memes and delivering it efficiently. Now you have the era of biotech, and that's what COVID and the scientific breakthroughs that came out during COVID really came out to see. So I'm excited to see the investment opportunities there in biotech. Now, I don't think the indices themselves yet are seeing that uptick, but those individual opportunities are really coming out. Tyler, thoughts on that?
Yeah, is it Regeneron? I believe it's Regeneron is another one that is acting very well, near highs, looking like it wants to break out, I believe. So yeah, I mean, that's something that seemed almost too obvious to us in terms of what's next in terms of innovation. Well, we want to live forever. We're going to start to pursue the next frontier of healthcare. We want to beat all cancer. We want to beat, things like this. And we're getting closer. It's really fascinating what's going on in the space. There's really some smart people doing some really crazy stuff. And it's working, and we're moving forward. So yeah, that's one that we think you can own because, I mean, yeah, net funding dollars in a recession is probably lower for things like that, but you can't stop good innovation. And we think biotech is where the good innovation is now and will continue to be. I wouldn't be surprised if some of those names are the next bull market's leaders. That wouldn't surprise me, in the least.
Now, remember, in '08, if someone told you social media is the future, and if you invest big in that, you're going to make a ton of money. If you threw your whole retirement account into MySpace, that wouldn't have done you much good, right? So you have to know who's competent, who's good at this. Facebook had a great team. They charged forward, and they were able to capture that value, right? So who is competent in the biotech space? It doesn't mean that everyone's going to be a winner here. There's a lot of laggards that are still attached to old ideas that haven't had the innovation and development pipeline that some of these others have. But I think that it's a great time to invest smartly in the right tickers. And that's what leads me to our next announcement, which is that Foliko Lite is now available on every ticker to everyone for free. It's indexed by Google now. So actually you can just Google Foliko and then the ticker symbol, and it's going to take you usually to the right page. When it's a ticker like Amazon, we're still optimizing our search results and search optimization there. But by and large, that's going to be what you can do. For all of our shows, we're going to put direct links to all that analysis in the description below. So check the description below. You'll be able to see links to all the tickers we discussed today. We have more data, interesting data, and just incredible insights coming to you again in the future. So stay tuned to Foliko Live in this channel. We're going to bring you more insights in the future. Tyler, any last thoughts before we go?
No, not really. I mean, this is still pretty ugly. I see TLT down 1%, Q's down 2%, ARC down a clean 5.5%. So I have nothing constructive to say.
My dad was talking to me the other day, and he said, I've got a lot of, he just sold his house. He's like, I've got a lot of cash right now. I've got to get rid of it and put it like in the market or somewhere. I'm like, well, all right, cash is worth what, 8.2% less than it was this time last year. But at least it wasn't in the market.
Right. Yeah. I mean,
So
there's a lot of money for CDs and T-bills for the first time in decades.
there you go. All right, everyone. Thanks for joining. We will see you next time on Foliko Live, and have a great one.